Hey, it's Mike. I'm not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're talking about my XDTE payment, as well as what is going on with the stock market. So as you guys know, on this channel, we borrow money, and what we do is we invest in high quality foundational holdings, and then we borrow against those high quality foundational holdings. Ideally, what we're borrowing is income funds. You're not investing in growth companies. You're not investing in ETFs. You're investing in income investments. So predominantly, I own a covered call fund that does synthetic covered calls on the S&P 500. And so what I did, I initially borrowed $300K. Now I've paid it down to $282,978. And what I'm doing is this is building me a side stream of income. So the goals on why am I borrowing money to do this is a couple of reasons. Is in my brokerage account, in this Robinhood account, I am no longer putting any of my own money. So any of the money that is generated is being generated from this portfolio. So whatever income investments or dividends are paid out from companies, it is the income generation from this portfolio is what is going to keep powering it and buying more positions. So ideally, borrowing this money is the income arm of my portfolio. And the wonderful thing about it is I don't have to use my own money for it. Then ideally, what you're doing for this is you're investing in income funds that maintain net asset value. And then if you're investing in high quality growth stocks, I believe Tesla is a high quality growth stock. And so if you have a high quality growth stock over time, it will grow, and then you can borrow more money, you scale it, and then you can live off of that money. All right, the most important thing is how much did I get paid this week? I got paid $1,069.14. This last week, our president, Jimmy, one of our former presidents, did pass away, and it closed one of the days of trading for the week. So this payout isn't as much as it normally has been. But also the stock market is somewhat taking a little bit of a dump. And I have a couple of reasons why that's happening. So if anyone is wondering why the heck did the stock market drop, I have some insight over here. So first thing first, let's just take a quick look at the S&P 500. So this is my portfolio. It's worth $239,000, but it's actually worth more. But my calls that I'm selling is making this value less. But we're talking about the S&P 500. So in the last day, it's down about 1.6%. In the last week, the entire S&P 500 is down 2%. Why is the S&P 500 down 2%? This is actually a decent amount of money. And a lot of people are saying, oh my God, the crash is happening. Nothing's crashing. It's only down 2%. If you look at the long term, I mean, we're still at pretty much all-time highs. And if you look at the 5-year, I mean, this is still at a really good level. But the stock market is down 2%. And we only like when the stock market goes up because we like seeing our money grow. So these are the couple factors of what is happening with the stock market. So just recently, let's just move on the portfolio. Oh, I'm going to be holding cash, and I'll talk about that in just a moment. So this is why the stock market is down. So just recently, Jerome Powell, they released some statistics, and the labor market said that they gained 260,000 jobs. What the expert consensus was is that they were going to gain 160,000. So what does that mean? So you have a job report, and we've added more jobs than we anticipated. Why is that important for the stock market, and why is the stock market down? The stock market is down is because if there is strong job growth, that means people can spend more money. People have jobs. They're not pulling from their savings to stay alive and buy food, gas, groceries, and things like that. There are more jobs in the economy, and more jobs spend money, and more money being spent puts inflationary pressures on the market. In the short term, a strong labor market is actually really good. So what this means for the next 12 months, if we're gaining jobs, the stock market is going to be looking good because all the company earnings are going to be propped up from extra job growth. However, what the Fed is going to have to do, if the Fed notices that the inflation is starting to creep up, they are going to have to increase their interest rates. And so what ends up happening is the market loves certainty. We like to know if the stock market is either going down or up. We don't like uncertainty. And in Jerome Powell's last meeting, they said that Jerome Powell is going to adjust the interest rate according to what the inflation and data says. If data is hot, they're going to interest rates. If the inflation is cooling down, then he's willing to keep cutting rates. Now, at the end of the press conference, he did mention that nevertheless, we're still planning on tracking to cut. So according to whatever he said, we're still planning on cutting, but people in the stock market, we don't like this gray area. We don't like this interim or this no man's land. We like to know what's happening. And so with this uncertainty, people were starting to sell out. Other things to keep in mind, if like there's a strong job market and there's fear that interest rates might go up, growth companies' valuation depend on cheap debt, cheap interest. So growth companies, their earnings are put out into the future. So if your earnings are put out in the future, that means you're not making money now, and then having things cheaper puts you at a higher valuation. So then the question to ask is, well, if interest rates are going to go up, why am I going to put my money in equities that have a possibility of dropping 50%, where relatively speaking, if I put $1 million into bonds, I'm pretty much going to get my $1 million back plus my 5% interest. So that's why the market, people were making choices whether they wanted to go into bond yields or get back in the market. But this is a very dumbed down explanation of why the market is down. So with that being said, this is what's happening in the market, at least what my analysis of the market is. So what am I doing to position myself in the best place to win? I don't know if I mentioned this at all, but I have a 403B where I'm investing in the total international market, the total US market. I have a Roth IRA where I'm investing in SCHG. So I'm already putting all my safe bets into my retirement funds. However, in my brokerage account, that's where I start deciding to get a little more creative with the different strategies that I'm using or deploying. So right now, majority of my position is in a growth company, Tesla, which I think is the most premier growth company out there. And I believe it has the highest runway to take off in the future. So pretty much a lot of people are like, well, if the stock market's going down, why don't you sell your shares and buy in a cheaper price? I am not trying to time the market. If you look at people that have generated the most wealth over time, Elon Musk, Jeff Bezos, Warren Buffett, they held on to things for a long period of time. They weren't buying in and out at specific times. However, I can argue that differently for Warren Buffett. He's actually a pretty good market timer. You don't build wealth by getting out of a good company. The stock price could be high, the stock price could be low, but if the company itself is doing well, there's no reason why you should be getting out of it. So for me right now, I'm not doing anything with my Tesla position. And actually from a positive note, I'm selling covered calls on Tesla, which means that my self-strike prices are actually below what I'm selling them for. So technically in the 2 years, if we can maintain the share price, I pretty much got all this money for free and I don't have to roll this up. So there's nothing I'm really doing with Tesla, and my Tesla call is not doing anything. Like these are locked in until 2027. So we're locked in for quite some time. So let's just pop on Tesla, just see what the gain loss is. I think people like to see that. All right. So my current market position is $353,790. The highest position the highest number that this hit this year was about $405,000. And that still puts me at a plus $113,000 off this cost basis. So again, we're still in a pretty good spot. And then my XDTE position, because the stock market is down 2+%, this XDTE position is down 6% here, which is a pretty good amount of margin. But there are a couple factors why it's down. Is they had 2 really high payouts at the end of the year in December because they weren't paying everything out all year. And when they decided to give it back to shareholders in the last 2 weeks of the year, so the payouts were higher, which ultimately did decrease the net asset value, but eventually will recover once the stock market recovers. But we're getting payments every single week. They're over $1,000. Good position to be in. So yeah, our Roundhill position, we're getting paid weekly income. That's the wonderful thing about this Roundhill covered call fund is every single week you get a payment. Again, margin rate is 25%, and then we'll just go to the actual thing here. So January 10th is the payment. We got paid 18 cents on 5,641 shares. Some of you guys might ask, why am I not reinvesting this money into the fund so you can make more money? Going back to risk mitigation. If I just keep reinvesting my money, then I'm not reducing my margin percentage. So I already have a low risk of being margin called. But if I keep stacking out every single week more and more money, my buffer gets bigger, which means it's a much safer and safer position. So I'm just pretty much trying to keep stacking cash for the next 52 weeks to kind of ride this out for a bit. So my margin status is low risk. Let's just quickly look at my interest rate here, 5.25%. It's the lowest out there. And yes, I'm just trying to pay this down and be in a much more cash position. So, if I do pay this down and then opportunities arise, I can then go ahead and use that extra margin that I open up to invest in those opportunities. If the S&P 500 truly drops 50%, then I'll take that money that I had set aside, buy back in, and then now I have a higher chance of getting a 50% return on my money. So right now, I'm not looking to go in equities really heavily. I put in my 300K, reducing my margin every single week. And that's kind of what I'm going to be doing for the next 6 months. And again, this is going to change because I'm human. I change my mind, and according to what the data shows, I'm going to change my mind. Like I'm not set on one thing at a time. But you can see here, my total equity position over $500,000. Margin is used about 54%. I really want to get this down to 25% of total margin used, or what I call 50% of my equity. That's where a position I would like to be in the future. But right now, I'm willing to take that risk and pay it down now with a higher margin amount. Looking at this margin investing tab, so that margin maintenance number. So this number is the most important thing if you are a margin investor and using margin. My margin maintenance amount is $63,000. So for me to get margin called, my portfolio would have to drop down to $63,000. That has not happened to me in the history of owning this portfolio. The lowest that it's ever gone for me is $118,000. Going back to that tab, $63,000, and yeah, so that's a good position to be in. So, the market is always going to change. I mean, wars can happen, new economic tragedies can happen, but for right now, it's better to be in a higher cash position, especially that since we're in all-time highs. In my last video, I mentioned that the Shiller PE ratio, which is a metric of like long-term valuation over 10 years, we're the highest out. This is the third highest eval that we've been, or valuation we've been in history. So we're starting to push towards the expensive side. And again, to keep pushing more and more margin, not setting aside it isn't cash, or just, paying down that margin faster, would kind of be a little reckless. All right. The only thing I want to talk about the spreadsheet is I don't care about any of this stuff. Goal is to make about $60,000 a year with this 300K position. Total return. So if you add the total income minus the performance, we're at about minus 3%. Not that terrible that it was saying that it was down 6% on Robinhood, but it is what it is. But yeah, I'm going to make these weekly update videos about how much XDTE is paying, and maybe a little market report as well on why things are happening the way they are. I hope you liked the video. Hope you take care. Hopefully this motivates you to do something similar like this. If not, that's fine. Hopefully it's good entertainment, but I hope you have all a good one, and peace.